Hi, I'm Peter Rose, founder of Longwood Currency Trading. When do you swing for the fence? When do you go for it? I've been getting a lot of emails lately that are asking me, gee, on your videos, you talk about swinging for the fence and how you do that or whatever. But when do you do it? You know, there's no way we have any control over how much money we make, right? When you're looking at this trading game, the only thing we have control over is our risk. If the price is going to go 10 pips or 100 pips, you don't know. There's no way to predict that. There are ways of evaluating an entry situation as to what's the current momentum of price and does it have the probability that it'll get to your profit target. There are other methodologies that when you're in the trade during position management, you can sort of determine, well, how much gas is left in this thing. You notice that we're constantly talking about some limiting factor, which is the profit target. Why do we talk about a profit target? If you're trying to get as much money as you can, why don't you just enter the trade and let that sumbitch run? Because order flow doesn't work that way, particularly in the currency market. If you look at, I'm a day trader, so let's go down and we'll look at the 5-minute chart on the majors. And you'll see that a 5-minute chart has a period ATR of about 5 pips. And you'll see it go up, I don't know, maybe between 15 and 30 or 40 pips. And then it'll have a retracement. That retracement could be 30 pips, it could be 10 pips, but it will be, if you just play the retracements, you'd have enough pips to make a good living. But you can't play the retracements because they're even more volatile than the price action itself. But if you look at that chart, you can say, well, I think the way that this thing is oscillating, that I could get 10 or 15 pips. And how much more do you need than 10 pips? Well, look, if you're trading a mini account, it's 10 bucks. It's not going to change your life. If you're trading a mini account at 500 to 1, maybe it's 50 bucks on a mini or $500 on a full lot. But you shouldn't be trading at large leverage, because if you're trading at large leverage, you're looking to knock it out of the park. You're swinging for the fence on every trade. And I don't know who you're listening to out there, but you can't swing for the fence all the time, because from a statistical standpoint, it doesn't work. And though it may work 4 or 5 or 6 times in a row, the time that it doesn't work, it takes it all. So that isn't going to work for you. The concept behind buying real estate, for example, is it's not going to go up 50% a year. It could go up 50%. But what does it normally go up? Well, if you're out on the coast, you can get 7 or 8% a year on real estate. It's just a commodity, okay? That's what you can figure on over the long term, 20-year time frame. There are periods in that where the real estate will go up 25% a year. And there are other periods where it'll lose 30%. So you've got this constant flow, no matter what the asset is that you're looking at. But we're looking at currencies. Just look at the chart. What's the likelihood if you're a day trader? Well, what's the likelihood that you'll be a success as a long-term trader, as a position trader, a swing trader, looking for 50, 100, 200 pips? I'm going to carry the trade for, I don't know, 3 days, 3 weeks or something like that. Not very likely, because the price will go up 100 pips and then it'll come back down 75. So if you're in there watching that and you're trailing your stop, you're not even going to get out of the first day. It's very difficult unless you're really, really skilled. I've been looking at the currency markets from 2007. I think I have a basic idea of order flow in the currency markets. I've been looking at the general financial markets since the mid-1970s, and I invested in real estate for 40 years. I'm just telling you the way it is. So if you don't believe that, go watch some guy driving his Lambo and trading and at 500 to 1, and he'll tell you all about the times he takes $1,000 to $30,000, but he won't tell you about the times that he lost $70,000 because it was the last time that he had a good run and he just ran into a bad hit. So if we look at trading, trading is done incrementally. You trade for some specific percent return against your bank on a yearly basis. Now, if you've traded for a while and you understand how to develop trading metrics, you'll have a general idea of what you're capable of on a daily basis, weekly, and yearly basis. That's your baseline. And you have to do this without trying to swing for the fence, because that throws things off. And you'll have to do this without holding on to losing positions for 6 days or going for margin call or whatever it is that you're going to do to yourself. You have to develop your metrics to see how good of a trader you are. Once you know how you can trade consistently, that will give you a clue as to when an anomaly will occur in the price action, and you can let that run past the profit target. When I work with someone, we actually get into the math. You don't even need to be a math expert, because I do it for you and show you how the different win-to-loss values and profit targets and all the rest of the stuff, how they result in different end results as far as percentage return against bank. We can do that, pips made a year, whatever. The idea is to establish what's reasonable for you. Now, that reasonableness will change as you gain in experience, and that's true. However, there's a limiting factor that the market will give you on a consistent basis, and that's based on general skill and the ability to look at the market. Why do you think that all of the really successful traders say that 80% of their profits come from about 4% of the trades, or maybe 10% of the trades that they make? Why do you think that? And how do you get ready for those big moves? There you are, you get your bank all set up. Let's say you're trading a one full lot, and here comes this big opportunity, and so you're there with your one lot at $10 a pip, and it goes 200 pips. Okay, great, you made a lot of money in relationship to the size of the bank that you have, but you didn't make a lot of money. If you had it was trading a 20 lot at $200 a pip, and it ran that 200 pips, you'd have some significant money, right? So what gives you the ability to, when you strike for the fence, when you swing for the fence, that you're safe in doing it? The problem in swinging for the fence is that it's not safe when you're trading a short stack, because you're going to put it all on the line at the wrong time to try to take advantage of the big move. The smart money gradually goes into the price and follows that price up. As the price comes back down, they're going to lose their last one or two trades that they put in, depending on the spread between where the entry was and where that current price is. So they may lose the last two trades. So if you're staging in 3 lots at a time, and then all of a sudden you stage a 10 lot in, and price drops 15 points dramatically, which it does, 20 pips or something, you're screwed. You've lost all the money that you accumulated all the way up. So there's strategies for this. In my advanced solutions course, I spend probably, 30, 40 pages of discussion on large lot size trading and how you manage that. Swinging for the fence is a specialty. Swinging for the fence is an anomaly in the trading. What your job is, as you're trading, waiting for that anomaly to occur, is to build up as much money as you can. And that means not taking a lot of risk, because you can't withstand that drawdown. When I'm trading at 20 lots or something, I don't go in with 20 lots. I might go in with 3 or 5, so that if I lose $300 or $500 or $800, something like that. I don't want to go in at $200 a pip. As the price continues on, it will probably have a retracement before it gets to my a 20 pip profit target. Again, I'm a day trader. I'm on that 5-minute chart on a major currency pair. So at that point, I've got 8 lots in. You know, maybe I started with 5, and maybe I added another 5 or 3 or something like that. So I got eight lots at an average price of here, and the price now is 8 pips above that, and it's starting to stagger, and it starts to come back, and I get out. So I've made 5 pips at 80 bucks. I've made $400. My trading statistics are that 80% of the days I am profitable. So by taking that $400, minimizing my risk, I consistently end up having an equity curve that will grow. And then when it's time to make that probabilistic determination that the price is going to go beyond your profit target, now you start aggressively adding to the position and watching it, because if it turns around and comes against you, you got to go right away. You got to get out to preserve what you have, because by growing your account, you'll have more to add into the position when you get a runner, when you get a big time runner. And that's the way that you make a lot of money trading Forex. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.